What is an SCPI? Before jumping into the details, let's briefly explain what an SCPI is. An SCPI, Société Civile de Placement Immobilier, is a collective investment vehicle that allows investors to buy shares in a professionally managed portfolio of real estate assets. The rental income generated from these properties is then redistributed to investors as dividends. It's essentially a way to invest in real estate without the hassle of managing the properties yourself. Why invest in SCPI? 1. Accessibility. Unlike traditional real estate, investing in SCPI doesn't require a large initial capital outlay. SCPI shares can often be purchased for as little as a few €100, enabling diversification even with a modest budget. 2. Diversification. SCPI portfolios typically include a variety of properties: office buildings, retail spaces, residential units, hotels. This geographic and sectoral diversification reduces the risks compared to direct property ownership. 3. Passive income. SCPI investments generate regular income through rental payments from the portfolio's properties. These earnings are distributed monthly or quarterly, offering a steady stream of passive income. 4. Delegated management. One of the standout benefits of SCPI is its hands-off management. You don't have to worry about finding tenants, handling maintenance, or dealing with daily property management. This is all managed by the SCPI operator. The risks and drawbacks of SCPI. 1. Income volatility. SCPI income isn't guaranteed and can fluctuate depending on the profitability of the portfolio's properties. Economic downturns or high vacancy rates can lower yields. 2. High fees. SCPI investments often come with entry fees ranging from 8 to 12% of the invested amount. These fees can eat into your returns, particularly for small investors. 3. Lack of liquidity. Unlike stocks or ETFs, SCPI shares aren't easy to sell. If you need quick access to your money, this can be a major downside, as reselling shares can take time. 4. Real estate market risk. SCPI investments are still tied to the broader real estate market, meaning they're exposed to economic recessions or drops in rental demand. Even though SCPI portfolios are diversified, a significant downturn could affect overall profitability. Investing in SCPI in 2025, is it still a good idea? The current economic climate. In 2025, the global economy is still dealing with the aftermath of previous crises. High interest rates, elevated rates can slow the real estate market, impacting property valuations and rental demand. Inflation. Rising inflation can erode SCPI yields, although some SCPIs adjust their rents to account for inflation. That said, real estate continues to be a solid refuge against financial market volatility. SCPIs offer a convenient way to invest in real estate while benefiting from professional management and diversification. Positive trends in 2025. Many SCPIs are diversifying further by investing in growth sectors like flexible office spaces, co-living housing, energy transition assets. These strategic investments may make SCPI portfolios more resilient to economic fluctuations. Conclusion: SCPI in 2025, good or bad idea? Investing in SCPI in 2025 can still be a smart choice, but it depends on your investor profile and financial goals. If you're looking to diversify your wealth without directly managing properties, and you're comfortable with some income volatility, SCPIs remain an appealing option. However, be mindful of entry fees and liquidity constraints, and take the time to choose SCPIs that align with your expectations and investment timeline. Thank you for tuning in to Next Vault. Don't forget to subscribe for more tips, analyses, and strategies to help you succeed in your investment journey. See you soon on Next Vault.